How does a law firm make money? A law firm is like any other business. You make money when you have profits, and profits are the difference between income and expenses. So, the income for a law firm is you do the work, you have legal services that results in the rendering of a bill, your client pays the bill, you have income. Then from that, you deduct expenses. Profit is income minus expenses. So, how do you generate income? And how do you do it based on your legal work? Well, one might think that it's kind of straightforward, that it's just a matter of doing the work and spending the time and multiplying hours times rates or something like that. And it's kind of simple. But it turns out that because of the complexity of law firm accounting and the way in which law firms work with their clients, it's not so straightforward. Law firm income is a function of working through the actual time worked and issuing the bill. But between the time of doing the work and issuing the bill, there are a number of pre-bill write-offs. And from the time of issuing the accounts receivable to the time of collecting the fees, there are some post-bill write-offs along the way. What we're going to cover in this video are all the components in all the steps that we can show you here on the screen that results in the leakage of maximum fee capacity, namely the money growing on trees, down to the fees that are collected. And it all comes back to both the client's perception of value and what a client is willing to pay for, as well as the efficiency and the effectiveness with which lawyers do their work. But some things happen along the way where, in addition to doing all the work and thinking that maybe you'll be able to have money growing on trees just by having all these billers, it's a lot more complicated. What ends up happening is that there's leakage. And the leakage occurs because you start with maximum revenue capacity, but then there's a diminution because obviously you're not going to work every hour of the day. So there's the actual time worked. And you're doing the work you need to do. You've putting in your hours and your timesheets. And then it turns out that all the work you're doing isn't necessarily acceptable to the client, because clients have outside counsel guidelines, and the guidelines may say things like, we only want partners working on this matter, or we only want certain associates working on this matter, or we don't think certain tasks should take longer than a certain period of time, and we want you to use task codes so that we can monitor the amount of time you put in against what our metrics are. And there are many, many more. And these outside counsel guidelines have been well thought through by in-house counsel and law department operations professionals, but they really are a bane to the existence of law firms because there are so many different outside counsel guidelines from so many different sources. And all the people who are working on that client's matters have to be cognizant of the different types of restrictions and advantages of different outside counsel guidelines. Then you move from the guidelines into rate setting. And the rate setting determines whether or not it's hourly rates based on the standard in the law firm's financial system, or there's a discounted rate or some other methodology. From there, you've got hours, rates equal the billing value. And then before you get the bill out, the partner in charge of the matter is likely to do pre-bill write-offs. We'll talk a little bit more about what goes into that. Then you're in the accounts receivable section of the law firm's financial system. The bill is issued, the client receives it, and sometimes there are post-bill write-offs. What happens? It means that the collected fees are less than the actual time worked, and there are a number of issues that come out of this. So in this lesson, we're going to be able to talk about what we mean by billed time, unbilled time, what the maximum revenue capacity is, realization, actual time work, outside counsel guidelines, discounts. There are an enormous number of terms that are part of this lesson, and we've provided a resource with you with the definitions. Okay, so you go from the maximum revenue capacity, which is the hours times rate times the number of people, and you have the actual time worked, which we all know is going to be way less than every hour in the day, or so we hope. And then from there, you're going to end up with the collected fees. Now, what happens? Well, there starts to be leakage. Where does the leakage come in and why? Because of outside counsel guidelines and the concomitant timekeeping adjustments. Okay, so we've gone from maximum revenue capacity to actual time worked, and now we're going to take a look at the impact of outside counsel guidelines and how they result in timekeeping adjustments. That means that the collected fees, namely the income, is going to be reduced from what we have on the timesheets, which is the billing value, namely hours times rates. So here's a sample report from the timekeeping system. It lists the timekeepers, associate 1, partner 1, paralegal, partner 2. It describes that they all attended the same meeting relating to the filing. They have different amounts of time that they put down for how much time they spent in the meeting, their rates, and the billing value equal to the time times the rate. Now, it may very well be that everybody spent the same hour and everybody recorded the time differently, but that's an entirely separate topic, which is about best practices in timekeeping and what one does in reviewing the timekeeping records. For now, we're just going to look at the fact that the timekeeping system shows that you have one partner who spent an hour and another partner who spent 7/10 of an hour. Now, the outside counsel guidelines are going to result in timekeeping adjustments. Why? Because the outside counsel guidelines say no more than one partner at a meeting. And if it's no more than one partner at the meeting, we have something that we have to address right here. We've got partner 1 with 7/10 of an hour, partner 2 with an hour. That results in $350 and $450 in the billing value associated with those two different partners. Now, there's going to be an adjustment because if you can't have two partners at the meeting, you've got to cut one. So are we going to take off $350 for the time associated with partner number 1, or is there going to be a timesheet adjustment associated with partner number 2, taking off $450? Well, for either way, we are not going to end up with $1150 as the billing value for this 1 hour meeting. In fact, for the sake of discussion, let's just take $350 off. One partner spent a whole hour, another one spent 7/10. We're just going to take him off rather than do the complicated to figure out what this would look like under different scenarios. So now you've already reduced the amount of hours times rates to a lower billing value amount because of the timesheet adjustment associated with the outside counsel guidelines. But we're also going to take a rate discount. Rate discounts are things like the client says, I will only pay you 10% off standard rates. Or maybe I'll pay you a full billing value on partner rates, but we'll take 25% off the associate rates. Or maybe we'll come up with some kind of blended rate scenario where we say, regardless of who spends the time, the blended hourly rate for the work is, let's say, $300 an hour. And then the burden is on the firm to figure out how it's going to make money with that kind of rate structure. So here we are, we've got the rate discount, we've got the outside counsel adjustment, and you put the two of them together and you end up with pre-bill write-offs. You've got the value of the unbilled time at actual rates, which is the difference between the amount that was billed at standard rates and the amount that was billed at actual rates. And so you can start to see how with this cascade, we go from maximum revenue capacity to the actual time worked at standard rates, which is how the law firm's business model is set up to optimize the amount of income it's receiving, to say that there are going to be pre-bill write-offs, namely write-offs or before the invoice is sent out to the client, resulting in what the collected fees may be. But wait, there's more. Let's take a look at the effect of this with rate discounts. We've just taken off partner number one. We've reduced the total amount from 1150 down to 800. And now we're going to take a further 10% discount. So the billing value was 800, which was based on the fact that after the outside counsel guideline, we're taking 10% off. And that brings us down to 720. So this started out as a meeting at which we were going to be billing 1150, and now we're down to taking the 10% discount and billing only 720 for the meeting. From the client point of view, that's probably a fair amount. That's what they perceive as their value for this kind of activity, not necessarily what the law firm's financial system says. So now we've gone from rate discounts, outside counsel discounts, and then we may add efficiency write-downs. What are efficiency write-downs? Well, it may turn out that more work was done than the client really wanted, that maybe they only wanted a bullet point memo and an extensive multi-page memo to the file was written. Or maybe there were too many people working on the same thing and there was rework, waste. Those are efficiency write-downs. And a firm, knowing that they are going to submit their timekeeping records to support the time that they have expended on a matter, will also know that the client won't pay it. So rather than having the client review the bill and take the position that it's an inappropriate amount, the law firm will take efficiency write-downs as part of the pre-bill write-offs. Okay, so now we had the rate discounts, the efficiency write-downs, the pre-bill write-downs, and now we're going to have pre-bill. So now we've been through taking a look at the amount of time worked and how the outside counsel guidelines have had an impact on whether or not the hours times rates and full billing value can be reflected in the bill issued to a client. But remember, we've also added rate discounts, and we've got to identify if there's anything else before we can issue the bill. Chances are there are some efficiency write-downs as well. The partner in charge of the matter may conclude that that memo that the associate wrote that took 6 hours probably was only worth billing 1 hour of time for. Or the partner in charge of the matter looks at the timesheets and sees that 2 associates did the exact same work because it wasn't clear who was supposed to do it. And again, they can't charge for the same work twice. So efficiency write-downs sometimes are added in addition to the rate discounts, in addition to the compliance with outside counsel guidelines. And then we've got the cumulative group of all of these, which comprise our pre-bill write-offs. From there, we issue the bill, at which point we have accounts receivable in the firm, and accounts receivable means that the firm has to wait to receive the money from the time the bill is issued and the time it goes through the client's bill review process. Well, you would think that you issue the bill and the money would come in, but it's not that simple. Because when we get to the client side, then you have post-bill write-offs, and that creates a further hit. So what are examples of post-bill write-offs? Well, the client comes back and says that the bill has been through their e-billing system, and the e-billing system has compared their outside counsel guidelines and what the law firm put in the bill. And as much as the law firm tried to get all the time that didn't comply with outside counsel guidelines out of the bill, the client has found additional items that are not in compliance. That's a further hit. Or the client has metrics about what certain kinds of work should cost. How much time should we be putting into due diligence and M&A? How long should it take a licensing agreement? Or to translate, not just in terms of time, what should the billing value be? What is the fee that we're willing to pay? What is the value we perceive is an appropriate amount to pay for the legal services rendered? So client metrics may also provide deductions based on the client perception that value is not received. All these items can often be turned up through comparisons generated by the use of codes through the e-billing system and through the complexity and highly rigorous perspective offered by software applications that clients frequently install in their law department bill review process. So now we've gone through the entire cycle, and then we've got a post-bill write-off. At that point, we finally have collected the fee. And the collected fee, as you can see, is a number that is a deduction from the actual time worked at standard rates on the law firm's financial system that gets entered into through timekeeping, and all the steps along the way. But at that point, the client has collected the fees. The big issue is, does the client perceive that there is value? And the big issue is, how does the law firm convey that in the number of different ways that it communicates with its client, the price is established, and the way the work is done. So going from there, we've tried to give you a perspective deep into the details about what it takes to go from the time that lawyers post in the timekeeping system, paralegals, lawyers, other timekeepers, down to what it takes to collect the fee. And for that, we're at the end of our first section on how a law firm makes money, focusing on the income side.